It's down the beach a little bit.
We're back. Shares of Bank of America are lower today. The stock, though, is getting a bullish call from Wells Fargo. They reiterate the overweight rating on the bank. You can see it's down 2.5%. I mentioned Liz Young has joined us here in Huntington Beach as well. So on one side, you'd say, OK, rates are up a lot. That's going to be good for the banks. The problem with that is if you're worried about the economy, and there's a report today that J.P. Morgan sees investment banking fees in the third quarter down 45 to 50%. You weigh the challenges versus the rewards. Which wins out? The challenges or the rewards?
Well, so there's a couple things. I think in this environment, when we're debating whether or not we're going to go into a deep recession, we all have this muscle memory of 2008, 2009, and we can't forget it, right? So we're looking at it as, oh my gosh, are we going to completely catapult into this debt crisis and everything goes under? No, I don't think that's the case. I think that we've purposely avoided that with a lot of regulations, and the banks are much better capitalized today, so that's not a risk in the sense that it was back then. As far
doesn't mean the stocks are going to work, though, right?
That's
right. The
true.
balance sheets are fantastic.
Right. Well, right. Comparatively, yes. Compared to that.
So that takes the scenario you're likening it to off the table.
Right.
But do the stocks work in this scenario, which I painted at the top?
So that's what I was going to get to. I think in the next 90 days to 6 months, they probably don't work great. I mean, rates are up, but we're more deeply inverted today, which we all know is not good for financials, right? And as borrowing costs rise, that's going to hurt their opportunity for revenue. And you look at things like housing affordability spiking higher. So there's not a ton of revenue opportunity in the near term. But if you look at the valuations, I think in the last segment, you guys were talking about energy being the lowest valued sector in the index. Financials is the second lowest. So they've already gotten killed, and they haven't had a ton of upside opportunity this year. It is a good time, I think, to start dripping in, even if we're late cycle. But then you got to hold it into the next cycle.
Yeah, I mean, as you're talking, I was just looking at the 2-year 375 on the screen as you were talking there, and you see the XLF is down 2.75%. Steph, it's Bank of America, it's Berkshire, it's Morgan Stanley, and it's Wells. Now, what's your outlook on the banks, given where we are?
Yeah, so I mean, I am very overweight the banks at this point. When I actually added to Berkshire. Berkshire is a little different animal. I don't actually consider it a financial. It's really more of a play on kind of they have, you know, the biggest rail company in the country. It's Apple, as I mentioned, Oxy. So it's a little bit of a different animal. By the way, they have $100 billion in cash. He can do whatever he wants. So that one is kind of a defensive play. But these others are trading at 1 to 1.2 times book. And that traditionally has been a very good time to own banks. And for Bank of America, I mean, Mike Mayo is the analyst that was reiterating it today from Wells. And he's been liking it for a long time, but I think he makes a very good point that they will benefit from higher rates. They have $1 trillion in sticky deposits. The low end of rates is where they benefit, right? In addition, it's a tech play. They spent $30 billion over the last decade on technology, and it doesn't get any credit for being a fintech company. They have good cost controls, good discipline there, and at a conference today, they talked about NII being up 20% year over year in the third quarter. So it's cheap. I don't think there's a lot of downside, especially if you don't have a deep recession. And so that's one I really like a lot. Wells is my biggest position, but I really like Bank of America as well.
Yeah, you were talking about net interest income, just to make sure we're all speaking the same language here. Jason Snipe.
Right.
Bank stocks being cheap. I always try to do that. Jason Snipe, banks being cheap relative to the rest of the market will get you a ham sandwich. I mean, it doesn't mean anything necessarily if the market is going to be upset further from here.
Yeah, no doubt about it, Scott. I mean, price does matter, but to your point, if there's no growth ahead, you know, what does it matter? You know, so, but for me, I think when I look at the banks, I mean, there's little stories that I think you need to pay attention to. One, if I'm looking at the asset managers, I think, you know, when you're looking at trading volume, trading volatility, I think, you know, Goldman comes to mind, and there's other opportunities. BlackRock, you know, is another name where you like, and then, you know, when we're talking about the yield curve, and obviously we're talking about an inversion now. It's not a steepening of the curve. You know, rates rising. I think net interest income, obviously, as Steph just mentioned, is an important story to pay attention to. And when I look at that, I think of the regionals, and I also think of a Bank of America, which is well situated there. So I think price matters. If I'm looking at the market in totality, I think financials could be another area, to look to as you're kind of traveling through a very volatile market.
All right, Jason, thanks for that. Liz, thank you for being with us as well. That's Liz Young of SoFi today.